Alright folks, welcome back. This is episode 25 of the ICT Mastery Mentorship. In this episode, we're going to be going over the smart money divergence. Or, in other words, the SMT. You've heard this term everywhere. Oh my god, SMT plus inversion. Oh my god, it's the best confluence in the world. Well, it's a pretty good one, but it's not amazing. Okay. It's not super great. But if I was to give it like a little accuracy rate or like a win rate, I give it about like a above an 80, about an 80%. It does very well, really. Like, whenever you see an SMT, it's very likely that price is going to, use it. But anyway, enough of that. What is an SMT? What is a smart money divergence? First, let me pose a question to you. Do you know what correlated pairs are? Do you even know what the word correlated means? Well, let's search it up together, shall we? Correlated. Have a mutual relationship or connection in which one thing affects or depends on another. In short, basically two things do the same exact thing, or they depend on each other. Very simple. In that mutual connection they're talking about, what do you think that is? It's on our you're looking at it right now. You're looking at the mutual connection. Probably like, is it the candlesticks? Yeah, that's exactly what it is. Because do you know what this is? Do you know like what is happening here within these candlesticks? The market is moving. Yeah, duh. But what else? Well, what number is changing? What is that? That's the price of the asset you're trading. So, what is happening with that price? It's fluctuating. It's moving up and down, up and down, up and down, up, down, up. That's the only thing the price can do. It can get more expensive or it can get cheaper. That's the only thing it can do. So that mutual connection is what? The actual fluctuation of price, okay? So correlated pairs are two or more, because there can be multiple pairs that are correlated with each other. Two or more pairs that are correlated with each other, inversely correlated or just, regularly correlated to where they do the same exact thing. One goes up, other goes up. Inversely correlated is, for example, the euro dollar and the dollar index. If the euro dollar drops, the dollar index will, rise higher. So that's inversely correlated. Anyway, we're going over two correlated assets, the NASDAQ and the S&P 500. As you can clearly see, if I zoom out and go into 30-minute, I think we can see how these assets are correlated just from, flicking through them. Like 3, 2, 1. And you can you see what's going on here. You can clearly see that they move almost exactly the same. There's very minor differences here and there, but overall it moves the same, right? They're correlated. But those differences, those very small differences that you see in price, or those desynchronizations, those are the SMTs. Those are the smart money divergences, because the two correlated assets that are supposed to be doing the same exact thing, they're desynchronizing. They're not correlating. So that's what creates that divergence, because they are diverging. Their mutual connection, which is the fluctuation of both assets' prices. This right here, this is price moving up, down, down. That's its fluctuation. So whenever they start diverging and doing opposite things within its price fluctuation, that creates a what? A smart money divergence. Now, probably like, okay, you just explained that to me. Well, what is it? You're not giving it to me. I'm sorry. Let me stop edging you. Okay, let me stop edging you. Anyway, let's go back to let's go to the 3-minute. Why not? Pay attention to these lows right here. This low right there, and this low right here. You can clearly see how this is just a regular low. Okay, the NASDAQ, mind you, this is the NASDAQ. Keep that in mind. Price created a low. Boom. Okay. Price tried to visit that low. Failed to do so. Now let's go to the ES and see what happened on, the S&P 500. Whoa. We both see that, right? Yeah, I think we can, both see that. We can clearly see that between the two pairs, what happens? One breaks the low, one doesn't. So what is that? Let me ask you, well, what is that? It's a desynchronization in price, okay? Price it's not correlating. It's not correlating. They're not doing the same exact thing. If NAS doesn't break the low, S&P doesn't have to break the low. Or vice versa, if S&P doesn't break the low, the NAS must not break the low. That's what it's supposed to do, right? That's what it's supposed to do. Quote unquote supposed to do, right? From what we're seeing and how price is moving, pretty similar between two assets, we can clearly see. It should do that, but it's not. That's what creates that divergence. So when this forms, since we are seeing a divergence between the lows of price, we should see price jump higher. Yeah, it doesn't do that. Let's see here. This is the SMT from this low to that low. That's the SMT right there. Does price jump higher? Yep. Immediately jumps higher, retraces, hits that. There's a PD array right here. You don't know it yet, so I'm not going to sit here and teach it to you because it's not time yet. But it hits that PD array, jumps higher, and fails to reach buys the liquidity here. And then it proceeds to drop lower during, what's that? It's a time zone, but I'm not going to tell you what specific time that is. But yeah, it's a macro. You'll know what a macro is in the future. But you can clearly see how SMTs work, right? It's not hard, is it? No, hopefully not. I hope it's not hard. Anyway, that's just a bullish example. There's multiple SMTs here, multiple. If we look here, here's a bearish example. Vice versa, if we see a SMT with the highs, like for example, the NASDAQ takes out a high and the S&P doesn't, what's that? That's a smart money divergence, a bearish SMT. So let's switch between the two. See that? I see it too. I think we both see it, right? It's right here. From that high to this high. That's your SMT. Nothing hard. Want to switch between it? Look. You know, let's put a line on this so you can really see it. Do you want to just have to eyeball it? I'll be the best mentor I can and make it easy for you. Now let's switch through. See that? The S&P fails to break that high, while the NAS does so. What's that? An SMT divergence. What should price do after it? It should displace lower. Okay? Whenever you see this form, you shouldn't see any slow movement. You should see immediate price delivery, especially if you're on the lower time frames like this. We're on the 3-minute. Just look how explosive that reaction was. And the SMT formed, and then it just said kaboom. it just exploded. See that? SMT forms, price comes up, fails to break that high on the S&P 500. NASDAQ does. The final hour, like the final 10 minutes of the day for the regular trading hours of the NAS and the S&P 500, it dumps and drops a good amount. What's this, like 100 points? Yeah, 105 points in a tick. That's a lot. That's life-changing money for most traders, especially for ICT traders or ICT, whatever the word is, smart money concept traders, whatever it is. But yeah, you get what I'm saying. Inner circle traders. Yeah, that's what you know what? That's what I'm gonna start calling y'all. Inner circle traders. But that's a nice name. I like that. Inner circle traders. Anyway, I'm getting distracted. Let me keep going. Let's keep going. All right, here's another one here. I think because today's price action was just, yeah, there it is. You already see it. I don't think I have to explain, but there it is. It's right there. So between the lows, from this low to that low, what's happening? Price is desynchronizing. It's becoming. Is that a word? Hold on. Give me a second. What's the? Oh, that's a word? Oh, what? Uncorrelated. Okay. Well, I'm going to start saying that in. Price became uncorrelated and failed to break that low on the S&P 500. And if we look back at the NAS, look what happens. It jumps higher, doesn't it? Like I said, SMT with the lows, or smart money divergence with the lows, price should head higher. SMT with the highs, price should head lower. Very simple. It's not hard at all. It's really not hard at all. And all you have to do to see it easily, because you don't even have to put this line here just to eyeball it. If we just flip through the two pairs, oh, that's all my drawings, my bad. We just flip, you can see right there. It's in your face. You don't have to do much. It's right there. Now let me give you a tip here. Since we're looking at the S&P 500 and the NASDAQ, right, and they are correlated, not inversely correlated or any of that. Since this is an example with the lows, right? Let's mark both of them with the SMT so we won't get confused. SMT, and go back here. SMT. Whichever asset doesn't break the low is the stronger asset for that, that move that's gonna occur following that SMT. So let's compare this move right here. Do you see this right here? This little jump up right there? Let's compare this entire thing right here. I'm gonna put a box on another one too. Let's compare it. About right there. I think that's about the same, right? Let me see. They're about the same. Which one breaks the low? The NASDAQ or the S&P 500? Clearly, the NASDAQ. The NASDAQ comes down, breaks that low, S&P divergence. What happens with the S&P 500 though? It does not break it. Now let me ask you a question. Which one has a higher magnitude? When I say magnitude, I mean it moved more. Okay, when it was displacing, it displaced more. Which one did that? I'm going to switch through. Which one did that? Now we can clearly see that the S&P 500 did that. The S&P 500 had more magnitude with the displacement. But look at the NASDAQ. The NASDAQ broke the low and did not have, it didn't have as much displacement. Reason being, it came down and broke the low. That's showing a weakness in its bullishness, okay? But with the S&P 500 here, it's like, oh no, we don't want to break that low. We want to keep going higher. And that's exactly what happened. This is called a failure swing, okay? We learned this. I think we learned it. I'm not sure, but I think I taught you that in chapter 1. But this is a failure swing. When price simply fails to break a low and or high, this swing right here is a failure swing. Okay? This is a bullish confluence. This is a failed swing low or a failure swing low because we failed to break below this low here. We tried to come down and visit it. We created another low, but what happened? We didn't hit that low. So what's this? This is a failure swing. What that means for price is if we want to see price go higher, and ICT has said this multiple times, even in his the trading all-time highs video. If price wants to go higher, you're not going to see as many sell-side liquidity purchase. You're just not. You're not whatsoever. They're going to be very, very minimal. Very minimal. Okay? Reason being, when price is bullish, what is it seeking? What is it looking for? Buy side. Duh. Duh. If price wants to go higher, it's going to be looking for buy side liquidity, not sell side. Duh. Duh. So, if we want to see price go higher, we do not want to see it come down below this low. If I can zoom in, we do not want to see it do that. The NASDAQ does that. It does move away because that's what both assets are supposed to do when an S&P forms. But the stronger, more reliable asset would be the S&P 500. As we can clearly see here, I don't trade the S&P 500 or the ES, but just 25 points. And y'all tell me if that's a lot. I really don't know if that's a lot. 25 points and 2 ticks. Is that a lot? Well, hold on, let me see. Let me just give me a second, guys. Mini. Let's see here. What? No way. Wait, hold on. Let me just get my website. Wait, what the heck? What? No way. I'm so sorry for interrupting the teaching like that. That is crazy. 1,200. What? Just off of that? Oh, wow. Yeah, that's a lot. That's just one contract. That's stupid. Are we serious? That's insane. Wow. Imagine 2 contracts. Just double that. That's insane. Wow. Okay, so yeah. Never mind, guys. I don't need to ask you guys that no more. That's a lot. Anything above 20 points on ES is a lot, from what I'm clearly seeing here. That's 2,500 with just 2 minis. That's insane. Anyway, we're going to do one more example here, and I do not want to make this video too long. I can, even find one. Let's see. I might go to the hourly. Yeah, let's go to the hourly. Let's have some fun on this thing. I think we found a bearish one. There should be, yeah, because this is a pretty decent move. And I think there is one here. Let's see. Yep, you can see it already. It's right there. That is your SMT. So when this forms, what should price do? It should drop lower. Does it do that? Yes, it does. Yes, it does. Oh, I keep going to that, man. I need to stop doing that. I'm ruining the teaching, man. I'm so unprofessional. Anyway, the NASDAQ hits that high. The S&P does not. Oh, now let's analyze both moves, okay? Let's analyze the magnitude between the two. We have sell-side liquidity here. Let's start combining the concept I've taught you. Sell-side liquidity here. And we have more sell-side liquidity here. Probably like, okay, both took out sell-side liquidity. Well, like, what are you getting here to? Like, come on, man. Like, hurry up, man. I want to learn. Anyway, which one has higher magnitude? Which one do you think? Now, if we look at both sell-side liquidity points, we can see that one goes through it deeper. It goes further past it. Which one is that? Look at the top left. Which one does it? Clearly, it's the ES. Clearly, it's the ES, right? And if we look, I think there's more fair value gaps on the S&P 500. Well, no. The S&P 500 does have more magnitude behind its move because it failed to break that high. And if we want to see price go higher and seek sell side, we shouldn't see it seek buy side. It's like no duh, right? and it does that. I gotta get more professional with this, guys. Anyway, Let me end this episode here. I talk way too much. This video is about 15 minutes long, and I'm not gonna make it any longer. I hope I taught you this well, and I'll see you guys in the next episode. Good luck and good trading.